Who?
Hold on a second. I can't seem to get there.
It's thinking about it. It says you're starting to share. Just there it is.
Right there. All right, go. Happy Monday, Charles. How are you?
Happy Monday. I'm doing well, Russ. How are you doing?
Good. Let's
Good.
let a few more people pop in and then we'll get going.
Cool, cool. Sounds good. We only had one Firefly note taker today. I don't know if that's good or bad.
Business is bad. All right, so let's get rolling. We got a lot to talk about. Will the negative jobs report hold off a September rate hike? So the big news on it was Friday, right? The 7th. The
Yeah.
big news on Friday was payrolls fell by 23,000 in July. And then, as they do every time they announce a new month, they also do some revisions to previous months because I don't know, they sharpen their pencil and figure out what the real numbers are. And they revised away another 103,000 jobs. Wage growth slowed to 3.2%. And in a strangely counterintuitive piece of the puzzle, unemployment remains at 4.1. This is a story of not um, job growth. It's a reduction in jobs, but the reason unemployment stayed steady and relatively low is because companies stopped hiring and people gave up working. And they
Yeah.
just said, I'm not going to bother to look for a job. And so unemployment drops when people grow so despairing that they just stop working on the hunt anymore. So the combination of job losses, downward revisions, slowing wages makes another rate hike, which about half of the Fed board was talking about or pushing for. It makes it much harder to justify. What else is
Yeah.
in this report?
This is such a fascinating report, only because when we go through and we're looking at this information, what we understand is that we have a job loss recession Fed. And so when we're talking about what's going to move the needle on rates, it's one of two things. It's either inflation and or it is job loss data. And so what we haven't seen over the years is too many moving of the needle when it comes to inflation, even though that's one of the things that we're going to be watching this week. It's more so, do the Americans that actually want to have a job, to Russ's point, right? We're not looking to see does every American out there is employed. It's a no, are we comfortable with the amount of people that should have a job that don't have a job being unemployed? And so when we're looking at this data, that's exactly what they're going to look for. And yet the inflation data is going to point to a lot more information for us, right, Russ? Like what we're really looking for is this going to turn into something where Americans are just going out and spending money on a lot of stuff? Because then that indicates out to the Fed that there's enough money out into the economy to where they don't need to do anything. And then us as real estate agents, we are disproportionately affected because a 6% rate on a $600,000 product, less people can afford that than the $7 item on Amazon.
Yeah, yeah. So if you're an agent and your clients are concerned about what's happening, I mean, we think that um, there's a talking point here in that the jobs market finally gave the Fed a reason not to raise rates. I
Mhm.
think our new Fed chair, Kevin Warsh, is more of an inflation guy than a jobs guy. So when inflation, would you say that's true, Charles? Would you agree with
Yeah,
that? Yeah.
yeah, I would say it's true, and it'd be a nice change of pace.
Yeah. So what we're gonna see happen here is when inflation data comes out for July, boy, if it was in our favor, we could possibly even by the end of the year see a drop in rates.
Yeah, we definitely want to see that number start cooling, right? We want to see that number start cooling off. And the more that that number starts becoming, it starts cooling down and to Russ's point, more favorable for us, then hopefully that indicates to the Fed, okay, we can lower the cost of money because we're not spending frivolously on anything that we can put on credit these days.
Right. So, all right. Second thing, mortgage spreads keep housing demand intact for now. So we know that there's a lot of factors that drive mortgage rates, and we know that the Fed rate is a piece of it, but the other piece of it, another piece of it, is mortgage spread. So mortgages right now are sitting around 6.74. But improved mortgage spreads are preventing them from pushing above 7%. And the context on this is the spread between the Fed rate and the mortgage rate, is a certain amount. And if that certain amount today was at the level it was at in 2023, rates would actually be up at this in the high sevens. And so that spread has dropped. Weekly pending sales remain slightly positive. Total pending sales are also positive, and purchase applications are showing weakness. What else do you see here, Charles?
Yeah. So as we're going through, what's very interesting is as we're looking at this data and we're going through, I like looking at purchase mortgage application data. I mean, I think that's one of the clearest indicators that as we're going through and we're looking at this is what we all need to keep our finger on this pulse. This is what is going to be happening over the next 30, 60, 90 days as we know that that's the timeline of our business. So, purchase mortgage application data, this is our consumer reaching out to the lender to figure out what they qualify for, whether it's either a refinance and or they're looking to go purchase a home. So, we don't care if it ebbs and flows up and down. I mean, up is a strong indicator that we're going to see, more people going out and purchasing homes, but what we definitely don't want to see a trend of is multiple year over year decline. And so last week, this was last week's data, right? Rear view facing mirror is that we had less people this time last week versus this time last week last year raise their hand to figure out what they qualified for. So this is something we're going to watch because if this starts trending downwards, that's going to tell us that we don't have a lot of consumers that have a lot of faith that the market's going to rebound and they're not looking to purchase real estate.
Yep, absolutely. All right, this chart looks kind of, or what is this, a chart? Yeah, chart. Looks kind of familiar. National active housing market inventory growth is at a crawl. And here, the big picture story is that in the US, inventory is only 2%, 2.1% higher than last year, which is a major slowdown from where we were this time a year ago, which was a 24% year over year growth. So things have changed significantly. July had 1,000,001 active listings, which is up only a little bit from a year before. The previous year was a huge increase over July 2024. National inventory is still 9% below where we were pre-pandemic, July of 2019. Um, and the market continues to be incredibly regional. So the Midwest and the Northeast remain tight, giving sellers plenty of leverage. And the Mountain West, us, and the Sun Belt are much softer. And
Yeah.
you can see, and we've seen this chart before, active housing inventory for sale compared to pre-pandemic levels. This is July 2019 versus July 2026. We're up 33%. We're up 33%, um, while the nation on average is up sorry, is down 9%, in
Mhm.
places like Illinois down 64%, Missouri, where I'm sitting right now, down 11%. Like the market we're in the tale of two cities. It's like when you're driving down 70 and you're in the express lane and everyone else is at a standstill. Well, we're kind of the standstill, and the rest of or many parts of the country, Midwest, Northeast, are still cruising along.
Yeah. Well, the Northeast is what's the fascinating part of this is that we did see this big shift in the pandemic time period. What we saw was we saw a lot of these digital nomads start to sprout, right? We started seeing a lot of people that were able to work from home, and their work from home took them to places like Florida, California, these areas that were more of like these I'm going to say tourist destinations, right? Where it looks like it's a fun place to be. There's a beach, like, hey, I'm going to be able to work from home and to have some fun. And or it could have taken them somewhere to where the housing was a little bit more affordable. Well, since then, what we've seen is this shift where the Northeast has just completely taken off. And the Northeast is where people are starting to move to. And when we're looking at this data, the data shows us that we consider 2019 this normal housing market. And so this is something that we obviously are going to care about more here in Colorado is that we're seeing more inventory on the board than what we saw in 2019, and yet that's still not the full picture. Because what we're also seeing is we're not seeing a lot of home prices go down, right? The right home for the right price is still selling. We're still seeing homes sit on the market. And as we looked at last week, we saw an influx of people that were putting their home on the market. Their home was expiring, and then they turned into landlords. So
Mhm.
this is going to be something that we're going to be watching for the next handful of years because inventory is increasing, but so's the population. And yet everything that we saw since 2008, when we saw the housing crash, now what we're seeing is some of the best balance sheets that most Americans have that they've ever had on their house. And this is what's forcing them to not have to sell. They're going to just hold on to the inventory, Russ. So like as we're looking at this and as we're thinking about just this momentum shift, what do we think as a real estate agent where we're seeing inventory is up? What are the conversations that we might should be having with our sellers and or buyers at this point?
Yeah, I mean, I think this is whenever inventory is up, you have to really double down on pricing.
Hmm.
And I was saying to some of my agents in Vail, like um, when inventory is high, when the market is starting to favor buyers, it can become really easy to fool yourself into listing a property for too much money.
Yeah.
And what I used to do uh, is I would go to a trusted friend in the business and try to justify my prices before I went on a listing appointment, because it is harder today to price a property than it was, 4 or 5 years ago, when the market was giving us all sorts of help, and even if you priced it over, the market would rise up and meet you before too long. Um, but I think doubling down on your pricing skills and studying the market every week, and learning how to ask for a price adjustment, those are the skills that I'd be working on right now.
Yeah, get comfortable having the uncomfortable conversations with your sellers.
Yep,
Yeah.
exactly. Got to get comfortable with getting uncomfortable. Five major housing markets that have the most motivated sellers. Denver ranks. Who wrote this article? I can't remember. This is out of
This is
Inman, I think.
Inman. Yep.
Yeah. Denver ranks number five nationally among major markets for seller motivation. And the way they, you know, the way they decide that is partially because of price cuts. 50.9% of active listings in our metro have taken a price cut. The median price reduction is 4.4%, which is kind of a healthy price reduction.
Yeah.
14.6% of listings are now priced below what the current seller originally paid. That's kind of remarkable. In Denver, 14.6 of listings are now priced below what the current seller originally paid. Um, that's a statistic I might be taking on my next appointment with a seller. Denver prices are down 6.7% year over year and 14.1% from the June 2020 peak. And we've got about 17,000 listings. Now, this sounds negative. This sounds like the world is ending, but this doesn't really mean that the Denver market is crashing. It just means that sellers have lost some of the pricing power that they had a few years ago. I mean, we went up and up and up and up and up, and then we started coming back down a little bit. But for most sellers, um, they're winning on their homes. Now there's a select few that bought in 22, and now they're going to lose a little bit, or maybe they bought in 21 and now they're going to maybe lose a little bit. But the vast majority enjoyed the record-breaking appreciation. So it doesn't mean that the market's crashing. How would you talk to agents about this, Charles?
Yeah, I think
What
to
would you
your
say
point,
agents should say about this?
yeah, just to your point, Russ, is that bullet point number four. Bullet point number four is telling this story that I don't necessarily agree is what is as earth-shattering as it may seem, right? We're looking at this and we're saying 14.6% of listings are now priced below what the current seller originally paid. Okay, cool. Not cool, but so we get this information and then we have to say, okay, well, who is this avatar of a seller? Well, this avatar of a seller is most likely someone that took the advantage of a chaff loan, someone that is in a situation where a life event has happened and now they are being forced to sell their property. And so they bought at the height, whether it's 20 to the end of 21 to sometime today, and life has happened and now they're having to sell their home. And home prices are not the same price as what they were back in 2021. So as we're going through and we're looking at this, guys, as the real estate economist of choice that our consumers are calling to be that fiduciary. And that's the important piece here is that fiduciary, right? We are not functionaries here. We are someone that is put into a place of authority to help someone make a decision regarding the most expensive asset that most Americans own. And so we have to look through and we have to be able to say, Mr. and Mrs. Potential Seller, does this home make sense? Slash, can you afford to be able to rent this home out instead of having to sell it?
Mhm.
Do we, as real estate agents, know all of the other mechanisms and mechanics and levers that people can pull outside of just selling their home? And I get it. We might look at some of these homes and say, well, I don't get paid unless we sell a house to be able to get a commission. And yet, people are trusting us to help them make this decision. So I would say this, Russ, like if an agent came through and said, okay, I'm looking at this article, Denver is top five, motivated sellers, and that's the key point, motivated because life event has happened. What is something that we should look at? We should be looking at, does this seller need to sell? Or does it make sense for that seller to put the home on the rental list? And where are they moving to? And can I help with that process instead? So that's how I would look at this.
All right, one last thing, DMAR's July 2026 market highlights. The big story here, and we kind of just told you it, Denver buyers have more leverage, but inventory is not continuing to surge. Sellers who adjust to today's market are still getting deals done. We should say that one again. Sellers who adjust to today's market are still getting deals done. And that's your job as an agent, to educate your clients on what they need to be doing in order to get a deal done. Charles.
Yeah, so as we're looking at this, guys, this is the Denver metro area. And so this is obviously closer to home. This is from our friends at DMAR. And so as we're looking at this, we have less inventory today than we did last month. So that's one of the big reasons why we're not seeing these huge price decreases. We can look at all these national headlines from all these companies that are going through and they're saying Denver this, Colorado that. And yet, to Russ's point on so many of these other phone calls, is that real estate is super hyper local. And as we're looking at this, we're seeing less inventory. We're not seeing huge price decreases, right? 605,000 was our median close price in the Denver metro, which was down 1.5%. Homes are sitting on the market longer, and there's opportunities for our buyers to negotiate. Now, one of the interesting things in here, and I've lost it at this point, is when we're looking at it and we're just talking about Colorado affordability and the new acts that are popping up. So we're going to continue to see more and more conversations pop up around affordability, affordability around Colorado, and these conversations and these bills. There it is. It's that I see it now. It's under Colorado affordability. It's bullet point number two. And it says Colorado's investing about $18.5 million dollars through Proposition 123. And if you're not familiar with what that is that's where they're going through and how many first-time homebuyer grants can we give out? How much multifamily can we help put some tax dollars behind so they can build more homes that are affordable for more people? While the nation is looking at affordability, we understand that in Colorado, we have a true affordability issue, and we're going to continue to have this conversation more and more. But Russ, like from these last two slides, we saw motivated sellers and we're seeing buyers win. And so, what's the big takeaway as we're looking at this as a real estate agent in Colorado from the last two slides specifically?
Yeah. I think to me, one of the takeaways is we have to do more hunting. If there's more sellers that might be a little bit upside down or might have to do price drops, like you got to expand your net, be in more conversations with people, call your entire sphere of influence, ask them to introduce you to people that they know that you don't know, and widen your nets so that you can catch more people. Because whenever things tighten for sellers, the way to keep on track towards your business plan, which requires a certain amount of listings taken and listings sold, et cetera, is to widen the net. And I think
Yeah.
that's unfortunately something that we are usually too slow to figure out. Um, when the market slows, you got to make more calls. I was talking to one of our agents in Montrose, Colorado, a couple days ago, and he's going to sell 36 houses out in Montrose to do about 17 million. His first full year in real estate. The number of TCPA compliant calls that he's making is astronomical. His goal is 50 calls every single day.
Wow.
And that's what he's doing to win. So to me, this data says you can still do great in real estate. You just have to increase the lead gen.
Yeah. Which is what Gary Keller taught us in Shift,
Yeah.
right? New
Gary's,
market. Go ahead.
yeah, I mean, Gary's book, Shift, says it's not about the market, it's about your plan, or I can't remember exactly how he says it, but you don't get rid of your goal, you have to adjust how you're going to hit it.
Yeah, absolutely. The market of the moment, right? And
The
over
market of
these
the moment.
last two slides, what we've seen is motivated seller, buyers are winning. And so are we making sure that we're having as many conversations as we possibly can around a game plan to help us get into more relationships with more buyers as there's inventory that's sitting on the board for longer so that we can help them win in today's market?
Yep. All right, Charles, thanks you all for being here today.
Perfect.
Regina
Thank you,
said it so
Russ.
much better. The market doesn't determine your success, it determines your strategy. That's what I was trying to come up with, Regina. Thank you.
There we go. Thanks
Y'all have
all.
a great week.